So welcome. Um, my name is Jonathan Lewellen. I'm one of the co-editors of the Journal of Finance. And I'm here today with the 2023 DFA prize winners, Nicolas Crouzet and Janice Eberly, who won for their paper on rents and intangible capital, Q+ framework. And we are really happy to have them here and wanted to congratulate them again for winning the prize. It's great to have you doing this. We're also joined by Jacobo Rodriguez. I think I probably said that wrong, but apologize. Jacobo Rodriguez from Dimensional Fund Advisors. He is the head of research operations and vice president at DFA. I think probably everybody is familiar with DFA, but just in case you don't, DFA is a global asset management firm with long-standing and deep ties to the academic community. They've sponsored the DFA prize here at the Journal of Finance for quite a few years now, sponsored other prizes as well at some of the competitor journals for much longer. So we're really happy to have him have DFA's partnership and have Jacobo with us. So we'll just ask Jacobo if you wanted to say hi and say anything.
Yes, thank you. Good morning, afternoon, everybody. Thank you, John, for having me and the Journal of Finance. And as we're just discussing, all I can say is that we're very happy and thankful that we can have this partnership with the Journal of Finance and the American Finance Association. Dimensional, since our founding almost 45 years ago, we've always looked to academic finance for to inform our investment solutions, and we're happy we can collaborate with the Journal of Finance to reward this the best in academic finance, this groundbreaking research that gets rewarded with these prizes. So thank you for the opportunity, and very happy to be here.
Great, thanks. Well, thanks for coming to the webinar, and thanks for being such a great partner for the Journal of Finance. Before we get started, I'll just mention that the Q&A function in Zoom should be up and working. So if anybody has questions as the seminar goes on about the paper or anything for the authors, please enter them into the Q&A window. I won't be interrupting the presenter during the webinar, but I'll try to gather the questions, summarize them, and ask them towards the end. We should have a bit of time at the end for some Q&A. So please enter any questions you have during the webinar in that. Now, I guess let me turn it over to, I believe, Nico is going to be presenting. So I'll turn it over to him. Nico, again, most of you probably know him, but he is an associate professor at Northwestern. So welcome, and I'll turn it to you.
All right, thanks a lot, John. Thanks for the introduction and for inviting us to give this webinar on our work. We're super happy to have a chance to share it with such a broad audience. So this is titled Rents and Intangible Capital, a Q+ framework. And it's joined with Jan Eberly, who's also here in one of the little boxes on your screen. So in this paper, we ask a simple question, which is why has investment in physical assets, in property, plant, and equipment been so weak in the US, particularly since the early 2000s? First of all, what do I mean by weak? Here's some data. There's two different sources here. The first is national accounts, and the second are firm-level balance sheet and income statements. What we're measuring in both cases is the gross investment rate. So that's the ratio of capex to the stock of property, plant, and equipment. And so these data show that gross investment rates among non-financial corporations used to be about 10 to 12 percentage points before the 2000s. Now they're down to about 7 to 9. Now, that observation per se, that investment's weak, is not super interesting. Maybe there's just few positive NPV opportunities out there. What makes it more puzzling is that measures of the returns to physical capital and the incentive to invest have been either stable or rising. So here's a simple example. This is from the same two sources as before. And what we're measuring here is a really basic proxy for average returns to physical capital. So the data from firm accounting statements, the blue line, is basically EBITDA divided by the stock of physical assets. And the data from national accounts, the orange line, is gross operating surplus divided by the stock of physical assets. And these numbers show that average returns in that measure rose from about 19% pre-2000s to around 23% in recent years. So it seems that investments declining, even though measures of the returns to physical capital are stable or rising, which is a bit of a puzzle. Now, there's two potential explanations that people have zeroed in on. The first one is what I'm going to call the economic rents hypothesis. So according to that hypothesis, firms' ability to generate pure profit or rent has been on the rise over the past 2 decades. Now, the source of these rents is a matter of debate, but their implications for investment are fairly clear. A firm with market power, for instance, has less of an incentive to increase scale at the margin, so investment will be weak. And at the same time, rents will boost measured capital income and drive up measured returns. The second hypothesis is the intangible hypothesis. So according to that view, the production function in many industries has been changing, moving away from physical capital and toward intangible. And as a result, the relationship between physical investment and returns might have become distorted. Okay, so intangibles is a bit of a fuzzy concept. Let me say just a couple words about it. It's a term from accounting, and it refers to all productive capital that doesn't have a physical presence. That can include a wide variety of different assets, things like software, intellectual property, brands, business processes, say inventory management systems, for instance. Let me give you a more concrete example. This is using Amazon's 2017 10Ks. In that year, about 18% of Amazon's operating expenses fell under two categories, marketing and technology and content. Now, the latter category, technology and content, is particularly interesting. It contains the payroll of employees involved in R&D. It contains the design and maintenance costs of Amazon.com, the sales platform. And it contains something called infrastructure development costs, and in particular, the costs of developing Amazon Web Services, the cloud service. Now, all of this is treated as an expense for accounting purposes, but Amazon, when they describe all of this spending, views this as investment, just not of a traditional type. So what they say specifically is collectively these costs reflect the investments, they use the word investments, we make in order to offer a wide variety of products and services to our customers. Now, measuring all of this investment is notoriously difficult, especially sort of at scale. However, the proxies we have suggest it's become more important over the last 3 decades. So here's one empirical example. If you measure intangibles, the stock of intangibles assets of firms as the capitalized value of their past R&D expenditures, you find, this is what I'm doing in this graph here, you find that the ratio of that stock to the stock of property, plant, and equipment has been rising over the last 3 to 4 decades. The magnitude is about a 2/3 increase. Now, if we think back to our question, how does this relate to the relationship between physical investment and measured returns to physical capital? Well, intuitively, measures of returns typically include something like, say, total profits, maybe total firm value in the numerator, but only physical capital in the denominator. So this is going to mechanically make measured returns to physical capital look artificially high. Okay, so these two explanations are the two ideas we're going to entertain in this paper. And before I move on, why should you care? Why is it worth paying attention? Well, in a nutshell, these two explanations have very different implications. The first one suggests that maybe market power is on the rise, with potential ramifications for policy. The second one suggests that maybe the investment gap is due to changes in how firms organize production, what types of assets they use. So maybe it reflects something more like ongoing innovation. So what do we do in this paper? We're basically going to try and tell these two hypotheses apart. And our approach is very simple. We're going to build a neoclassical investment model. It's going to have both rents and intangible investment. And then we're going to use it to quantify the contribution of each mechanism to the divergence between investment and returns. So today I want to walk you through some theoretical results, some empirical results. So let me go over them briefly. First, in the theory, we're going to focus on one key sufficient statistic from the model. And that's going to be the gap between big Q, which I'm going to call the average Q of physical assets. That's the ratio of firm value to the replacement cost of property, plant, and equipment. And little q, marginal Q of physical assets, that's how much the incremental firm value that is associated with an incremental unit of physical capital. So average versus marginal or minus marginal. And we're going to call this object the investment gap. Now, why is this an interesting object to look at, and why does it summarize this problem of diverging returns and investment that we're interested in? I'm going to explain more about this during the talk, but to fix ideas right away, we're going to look at a model where marginal Q, little q, is always going to be the right measure of the incentive to invest. But we won't directly see it in the data. Instead, in the data, we'll only be able to measure average Q. And so if there's a gap between the two, say if average Q is high relative to marginal Q, then the investment predicted on the basis of average Q will look too high relative to actual investment. So it'll look like there's missing investment in the data. And so looking in the model at what drives this gap will teach you something about the sources of missing investment. Now, our main theoretical results is that within the model we'll study, there's 3 drivers of that gap, 3 reasons why average Q might be bigger than marginal Q. The first is that traditional physical assets can generate rent. That's going to create a wedge between average and marginal Q. The second is the firm might have a lot of existing intangible capital. Now, that capital is going to boost firm value and hence the average Q of physical assets, but not necessarily their marginal Q. And then there's a third term, which is a combination of the first 2, and that one's going to capture the rent generated not by existing physical assets, but the rent generated by intangible assets, which will further boost firm value and hence at the average Q of physical assets, but not necessarily their marginal Q. Now, the first 2 terms in this decomposition here were sort of well understood in the literature. The third one is new to our model, and it appears because you're combining these mechanisms into the sort of the same, under the same roof. Then what we do is we're going to apply this decomposition to the data. We're going to start with aggregate data, so data from national income accounts. And with this data, our estimates are going to suggest that between 1 and 2/3 of the current investment gap is due to intangibles. That's going to be up from about 15% 30 years ago. So 1/3 is going to be the number we get from the national accounts, and 2/3 is the number we'll get if we aggregate it up firm level accounting data. And as I'll explain, the difference between the two is how broadly you can define or measure intangibles. It turns out the national accounts data is relatively narrow. It only focuses on intellectual property assets. Our second result, though, is we're going to find big differences in the investment gap across sectors, kind of regardless of how broadly you measure intangibles. For instance, in the 2 fastest growing sectors in our sample, which are healthcare and tech, 2/3 of the gap comes from the growing intangible capital stock. In other sectors like manufacturing, for instance, I'll show you that there's almost no role for intangibles. Now, as I'll discuss toward the end, sectoral differences are important because they cast doubt on whether when we look at aggregate investment and aggregate returns, we should really be drawing broad policy implications. Now, the last kind of bonus of our work is I'm going to show you that what we do gives us a new way of estimating the share of pure rents in aggregate value added or aggregate GDP. And that's a number that people have paid a lot of attention to in recent years. We're going to find estimates of this quantity that are about half of what we see in recent work, and I'll explain why. Okay, so the plan is I'm going to start by talking about the theory, and after that, I'll get to the empirics. So the model we use is fairly standard, but fairly general, a Q theory model. Here's the formulation. It's a lot of symbols, but things are very simple. The firm has one endogenous state variable, which is a vector, bold KT of capital stocks. I'm mostly going to use 2 capital stocks in this talk, one for physical capital, one for intangible capital, but I'll keep the theory general, so the number could be arbitrary. Now, these capital stocks are going to be aggregated into an index of capital. This is its non-bold KT I'm highlighting here. This is a real number. Through a function f, we're going to ask of this function that it has constant returns, though that's essentially your normalization. And then the firm is going to generate some operating surplus or EBITDA from this. This is this function pi t of KT. And finally, it's going to choose investment or equivalently next year's capital stock in a way to maximize the present value of distributions to owners of the firm, which are the difference between operating surplus and the costs of investment, which are this big function phi here. Now, we're going to make one key assumption here, which is that the revenue function pi is concave with respect to the index for capital, and that the elasticity is constant and equal to 1 over this parameter mu here. Okay, so think of that as a structural fixed parameter. Now, this parameter is going to feature prominently what follows. We're going to use it to capture the idea that firms might earn rents. Okay. In particular, mu is going to be greater than or equal to 1. And when it's strictly larger than 1, firms will earn pure profits. Now, we're going to be a little agnostic about the micro foundations for these rents. This could come from decreasing returns to production, what people call quasi-rents in production theory, or it could come from, say, inelastic demand curves from the firm's products, which would give rise to monopoly rents. Either way, the higher the mu, the stronger the curvature, the larger the rents, whereas when mu is equal to 1, the firm earns no rents. So in this model, you can derive a general result on the sources of firm value. So firm value is VT here, and you can see it has two big components, two pieces. Now, again, this looks a little scary, but let me walk you through the economic content here. First of all, imagine the rents parameter is 1, mu equals 1, so there's no rents. In this case, the second term in firm value disappears, and then firm value is just the value of installed assets. Each asset, each capital stock is valued using its own marginal Q, Q little n, which here is defined as the incremental firm value associated with an extra unit of that type of capital. This is essentially the standard Hayashi 82 result, which generalizes to the case of multiple capitals here. Now, imagine you turn on rents, so mu is larger than 1. Then firm value is equal to the value of installed assets plus this big term here, which represents the net present value of future rents generated by these assets. Now, what I've done in the lemma expression is I've highlighted the key term in this net present value, which is mu minus 1 times pi n. If you do the math, you can show that this term is exactly equal to the gap between the average and the marginal revenue product of each type of capital. So it's going to be positive whenever average product is above marginal product, which we interpret as a situation where the firm is earning rents. Now, importantly for our decomposition to get off the ground later on, you can see that everything here is additively separable across capital stocks. Okay, so we can think separately of rent attributable to physical capital, say, versus rent attributable to other forms of capital, including intangible assets. Okay, so as I told you in the intro, I'm going to focus on a particular summary stat of this model, which I'm going to call the investment gap. So let me motivate a bit this summary stat and define it. So imagine you specialize the model a bit and you assume quadratic adjustment cost. Then in that model, optimal investment is your standard investment Q relationship, which I've written in the slide here. Iota n is gross investments in a particular type of capital. Delta is the depreciation rate. Gamma controls the convexity of adjustment costs, and little q is little marginal q. That first order condition is just always true, even with rents. But importantly, it's the marginal q that is the correct proxy for the incentive to invest, not the average q. Marginal Q, though, is not observable. So to predict investment, you would use a regression like this one. So here, the only difference is the explanatory variable you'd use would be the ratio of firm value to the stock of capital of type N, which is average Tobin's Q, big Q for that capital. And so then when you compare predicted to actual investment, what you're really looking at is just the gap between average Q and marginal Q. In general, there might be a wedge, and that wedge is going to be proportional to that difference. So that difference between average and marginal Q is what we're going to call the investment gap. When it's positive, predicted investment looks high relative to observed investment, and otherwise it looks in line. So now we can derive some results about where these gaps comes from in our general model. So let me again walk you through different versions so you can build up the intuition. First, imagine there's no intangibles, so just one type of capital and no rents. So this is the standard case of Hayashi 82, and in this case, average and marginal Q are equal, and there's no investment gap. Now, if there's no intangible capital, but the firm earns rents on its physical assets, there's still going to be a wedge, a gap. And that wedge is going to be exactly equal to the NPV of future rents generated by physical assets. Now, imagine you shut down rents, but you allow for different types of capital, say physical and intangible capital. Now, there's still going to be an investment gap, a wedge, and this gap is going to be larger the larger this ratio S here, which you can think of as the ratio of, say, intangible assets to physical assets. That's what I was calling in the introduction, the omitted capital effect. If you omit a lot of capital, you're going to see a big wedge in the investment and a big investment gap. Now imagine we turn on the two mechanisms, the rents and the omitted capital effect. Then you're going to get these two terms, then you're going to get also a third one, which you can interpret as an interaction between the first two forces. The idea in words here is that the sum of firm value, sum of enterprise value is going to come from the future rents that existing intangibles will generate. And that's going to boost aggregate Q even more, and aggregate average Q even more, sorry, and average Q becoming higher in our language means that the investment gap is going to increase. Now, this decomposition in three terms is what we're interested in constructing in the data. It's still a little bit too general and complicated to take to the data while preserving intuitions. So I'm going to simplify things a bit. I'm going to focus on the case of two types of capital, physical and intangibles. And then to make things really transparent, I'm going to use a balanced growth model. So in the background, think of the revenue production function, so the function pi being proportional to some productivity process that grows at a constant rate g. And think of the discount factor as being some constant r that's bigger than g. I'm also going to assume that adjustment costs are low. This is just to make exposition easier. It's without loss of generality, as we show in the paper. Now, with these assumptions, the decomposition becomes a lot simpler, and it looks as follows on this graph. So let me explain the three terms here. First of all, when adjustment costs are low, marginal Q is close to 1. And so the omitted capital effect is roughly proportional to the ratio of intangible capital to physical capital. That's little s here. Moreover, you have these two rents terms, the rents of physical assets, and then the interaction of rents of intangible assets with the omitted capital effect. But they boil down to very simple Gordon growth formulas. These formulas say that this is our NPVs basically, and they're NPVs of the flow value of rent generated by each type of capital. Now, in these expressions, I've introduced a notation here. Big R1 is for physical capital, big R2 is for intangible capital. What these are just the user costs of capital. So I think the Jorgensonian user costs, the discount rate plus the depreciation rate for each type of capital. And so you can interpret in these expressions the flow value of rents is essentially the net markup over the competitive cost of capital or the user cost of capital. So this much simpler decomposition is what I'm going to take to the data in what follows. All right, so what have we learned so far? We've basically established there's three potential components to this investment gap. Rents from traditional physical assets, the omitted capital effect, and interaction between this omitted capital effect and the rents generated by intangible assets. And in specific cases, I show you how to express the present value of these rents more concisely. All right, now I'm going to move to measurement, and I'm going to start with, aggregate data from national accounts. So the first thing I want to do is explain to you how we construct this decomposition in our simplest approach. So what we're going to do is we're going to use this small set of data moments in order to construct each of the three pieces of the investment gap. So let me describe that. So first, we're going to use an empirical estimate of the stock of intangibles relative to the stock of physical capital to measure directly S. So we're not going to be inferring the stock of intangible capital as a sort of residual in our approach. Instead, we want to tie our hands to particular empirical estimates of how large that stock might be. So next, we need an estimate of the rents parameter mu. So for that, we're going to use the fact that in the model, because of the envelope condition, this parameter is always equal to the ratio of average returns to physical capital divided by the weighted user cost, the sort of weighted user cost of physical versus intangible assets. Now, the numerator is observable in the data, the denominator is not. How do we measure user costs? So here, what we're going to do is we're going to rewrite user costs as, instead of R plus delta, R minus G plus G plus delta. And G plus delta in balanced growth is just going to be the gross investment rate of firms in each type of capital, which we can also measure in the data. So then we're left with having to measure R minus G, often problem in finance. The way we're going to measure it is that in our model, R minus G has to satisfy this particular expression here that I'm showing on the slide. And everything on the right-hand side consists of data objects, rate of returns, rates of return, ratios of stocks, investment rate, and Tobin's Q in the denominator for physical assets. And so we're going to back out R minus G from this expression. Doing things this way has an advantage that whatever the composition we construct is going to, by construction, match the observed value of Tobin's Q in the data. So those are the moments we need here. There are 7 of them. So we need data now to construct them. So we're going to be looking at data from the national income and product accounts. The scope of our exercise is going to be all non-financial corporate businesses in the US. And we're going to use 6 time series to construct the moments. Investment and capital stocks, so the K's and the I's, are going to be drawn from the BEA fixed asset tables. Let me just say a word about the intangible part here. So to first order, you should think of what national income and product accounts measure for intangibles as the capitalized value of R&D spending. So it's really about measuring intellectual property assets. It does include some other things like the spending on own account software, but these are smaller. For profits, we're going to use also the NIPA measure of operating surplus. I should note that that has already been adjusted for the fact that spending on R&D is expensed. And then finally, we're going to construct an estimate of the total enterprise value of the NFCB sector by combining the market value of equity reported in the flow of funds with our own estimate of the market value of debt. So with this time series in hand, we can compute our 6 moments and then construct the decomposition for each year. We're going to do this in 7-year rolling windows of data so we can see how the decomposition changes over time. So what you're seeing on your screen is what we get when we do this. So the line with the crosses represents our estimate of the investment gap. This is for the case where adjustment costs are 0. So the gap is just average Q minus 1, but everything generalizes to the case of positive adjustment costs. Now, below that line with crosses, you see 3 blue shaded areas. The darker blue corresponds to the term that captures rents attributable to physical capital. The somewhat intermediate blue captures the omitted capital effect. So this is this guy here. And then the light blue captures the rents associated with intangible assets. 3 things are worth noting. First, there's 2 periods of elevated investment gap, the post-85 period, the 60 to 75 period. Second, during these 2 periods, the rents attributable to traditional physical assets seem to be the biggest factor. However, after 1985, the contribution of intangibles to the gap increases. In the 60 to 75 period is about 23%, after 85 is about 36%. Now remember, this is what we get when we use this somewhat narrow measure of intangibles, the one that's available in national income and product accounts. So we view this as maybe a lower bound on the contribution of intangibles to the investment gap. So what's going on economically speaking? We can use the model to give a more structural interpretation to the decomposition. So in the back of your head, think of a model that specializes the capital index to be a Cobb-Douglas aggregate of intangible capital and physical capital, with eta being the Cobb-Douglas share of intangible capital. And then I'm also going to highlight one prediction of the model for this parameter S here, which is the ratio of pure profits to total value added. And that's basically a monotonic transformation of the rents parameter mu. It's just more familiar units for people who have worked on this. So what we find, and so what I'm plotting here is our implied estimates of the parameter eta on the left and the parameter S on the right. There's 2 lines because I'm plotting the case with and without adjustment costs. You can see the 2 are substantially the same. So after 85, there's 2 things happening. The first is that intangible intensity is rising. So that's the left panel. It's doubled over the past 30 years, and it grew more rapidly from 85 to 2015 than from 45 to 85. The second thing is that rents have also increased since 1980. However, that's the right panel here. However, that increase is only about 7% of total value added. And that's, roughly speaking, half of existing estimates. Now, why is our estimate of pure profit shares lower and increasing less? And in part, it's different things. In part, it's because we account for intangible capital more carefully. But in part, it's also because the implied discount rates in our decomposition, so the R in the R minus G term, are higher and fell less than risk-free rates did since 1980. What this means mechanically is that a greater share of measured capital income is imputed to competitive cost of capital, and therefore a smaller share of measured capital income goes to pure profits. So I'll come back to this finding if I have time towards the end of the talk to connect it to some other work. Now, we can do many other things with this decomposition, and we do in the paper. Here's just one example. Here, the solid gray line shows how our estimates of the intangible Cobb-Douglas share went up after 1985. And the orange line shows a counterfactual where we ask the following. Imagine you fix rents where they were in 1985. How large of an increase in intangible intensity do you need to explain entirely the investment gap? And the answer is the orange line. Quantitatively, you need about 3 times the increase in intangible intensity that we saw in the data. If you translate this to a ratio of intangible to physical capital, it would have needed to go from about 9 to 39% instead of going from 9 to about 17, 18% in the data. This is bigger clearly. So in this first approach, intangibles are far from explaining everything. But remember, we're using a relatively narrow empirical proxy for intangibles, which is R&D investment. And I'm going to show you in a second that if you broaden this empirical proxy, the magnitudes get a lot closer to what this counterfactual is showing. Okay, so to recap briefly, in this first approach, we have 2 periods with large investment gaps. In particular, the post-1995 period stands out. In that period, about 1/3 of the increase is due to intangibles, and in the background, this is coming from a simultaneous rise in rent and in the intangible share. Now let's go to firm accounting data. I'm going to do this because we're going to be able to do 2 more things with firm accounting data. First, expand our definition of intangibles, and second, disaggregate results across sectors. Now, the approach is the same, but the data are different. Let me briefly explain what they are. We're going to focus on publicly traded non-financial firms. We need the same time series as before. So the capital stocks and investment flows are going to come from balance sheet and income statement data. For intangibles, first, we're going to capitalize R&D spending like in the NIPAs. But then we'll also consider adding another proxy for intangible investment, which is investment in organization capital. So here we're going to build on our colleague and co-authors' work, Andrea and Dimitris, where they suggest to use a fraction of SG&A spending net of R&D as a proxy for investments in that type. And this is meant to capture investments in workforce, human capital, brand capital, customer relationships, distribution systems, and so on. And Andrea and Dimitris have validated this measure in several ways in their work. The rest of the measurement is straightforward, so I won't spend time on it. First, this is what we get if we essentially repeat the exercise of before, but use this firm accounting data. So we just focus on R&D spending as a proxy for intangibles. Reassuringly, this is very close to what we found in national accounts data. About 2/3 of the gap are due to traditional assets, 1/3 to intangible capital. Now let's expand our empirical proxy and let's include organization capital in the measure of intangible assets. With this expanded empirical proxy, we find that about 2/3 of the gap is due to the 2 intangible related terms, so about twice as much as the baseline. Now, I'm not going to show you this directly, but this also compresses substantially estimates of the pure profit share or the rent share. This share falls about from about 7% in our baseline to 3 to 4% in this estimation. Finally, we can use the firm data to disaggregate the results across sectors. So the first way we do this is we split the data into the FAMA French 5 sectors. And again, our methodology is the same. We aggregate up firm level data for each sector, compute the decomposition of the gap. The main point we want to make here is that trends are very heterogeneous across sectors. So one extreme is the manufacturing sector, which is the top right here. In that sector, the investment gap is actually falling, and intangible intensity and markups appear to be declining. And the other extreme is the consumer sector, top left. There, the investment gap is rising really fast, but the decomposition suggests that it's all coming from rents associated with physical assets. The intangible related terms only account for about 10% of the gap. Now, the firms underlying that sector, consumer sector, are often retail and wholesale trade firms. Most of these don't report any R&D. Substantially, the only firm in this group that does is Amazon. So there's a question of measurement here. When we focus on R&D, which is what these figures do, we may not be appropriately capturing intangible investments that these firms make. And then there's high-tech and healthcare at the bottom. I should mention firms in the healthcare sector are not primarily healthcare service providers. They're more likely to be medical device firms, drug producers, so firms that invest heavily in R&D and for whom intellectual property assets are a key source of value creation. So these sectors look a lot more like the aggregate trend, an increase in the gap, and a rising contribution of intangibles. But the difference with the aggregate trend is that intangibles are much more important in those sectors. They account for about 70% of the gap in healthcare, for instance. So one simple takeaway here is when you're looking at the aggregate gap, it's a little misleading because whatever you're seeing is in part driven by differences in trends across underlying industries. So in this table here, what I'm showing you are the estimates of the underlying structural parameters, the intangible intensity and the share of rents across those sectors as of 2015. So this is, again, just using R&D. The message is consistent with the picture before. Consumer and services look similar, high rents, low intangible intensity. Manufacturing looks like a low rents, low intangible intensity sector. And then high tech and healthcare looks like a high rents, high intangible intensity sector. Now, what I'm doing now is I'm adding organizational capital to this measure and re-estimating the intangible share and the share of pure rents. The main point is that this reduces rents a lot for the consumer and services sector. These sectors look more intangible intensive and also more competitive with this expanded measure. So the measure is really that when you measure, the message is really that when you measure broadly intangibles, rents decline, and you see high intangible intensity everywhere except in manufacturing. Now, there are some difficulties about what exactly this proxy for organization capital is capturing within the consumer and service sector, because production is very labor intensive there. We've explored that in a separate short paper with Jan. We want to say that here we remain cautious and we view this estimate in green as maybe an upper bound on intangible intensity in these sectors. The last set of results I want to discuss are more about the relationship between rents and intensity at an even more disaggregated level. So in the previous analysis, you probably noticed that it seems as if high intangible sectors also have high rents. What I want to do is ask whether this relationship is systematic. I don't want to ascribe causality to anything here. I'm just interested in understanding whether there's a systematic correlation between intangibles and rents. For this, we're going to disaggregate the data further down to the level of 2-digit or 3-digit subsectors. And for each subsector in here, we're going to compute both intangible intensity and rents using the same approach that we use throughout the paper. The picture we get when we do this is the following. Here, I'm only using R&D as a measure of intangibles. The left panel shows, both panels show the value of rents on the vertical axis and the value of intangible intensity on the horizontal axis for each broad sector, and then for the constituent subsectors. The broad sectors are the solid dots, the constituent subsectors are the transparent dots. 1980 is the left panel, 2015 is the right panel. 1980, you see rents and intangibles low everywhere. Everything is clustered in the bottom left. 2015, you see that high tech and healthcare have moved to the northeast, which means rising rents, rising intangibles. Consumer and services have moved just north, which means rising rents, so low. And then there is manufacturing, which is interesting and different. Overall, it stays on the bottom left, but if you look at constituent subsectors, there are some that experience an increase in rents and an increase in intangible intensity over that period of time. The most extreme example is the one that I'm highlighting here with my marker. This is a sector, this is heavy, this is industrial equipment, the industrial equipment subsector. So think, agricultural or construction machinery, firms like John Deere and Caterpillar who spend a lot on R&D and product development. So that's the sector that went through the biggest joint increase in both intangible intensity and rents. So what we can do to sort of confirm these intuitions is we can pull the data into two broad groups of subsectors: high-tech, healthcare, manufacturing on the one hand, consumer and services on the other. And then for each of these subsectors, we can estimate a particular time trend of markups or rents, mu, and time trend of intangible intensity, eta. And then what I'm doing in these graphs here is I'm plotting the estimated time trends for each sector against one another. And what you can see is that there's a broad positive correlation within subsectors of high-tech, healthcare, and manufacturing, but no such correlation in consumer and services. Okay, so let me recap here. We're back to this idea that the growing gap between expected and actual investment is due to market power, omitted capital, and the interaction between the two. Empirically, with what we're seeing with this firm level data is the allocations to each term really depend on how broadly intangibles are measured, but also that sectors matter. Intangibles explain 2/3 of the investment gap in high tech and healthcare, for instance. And finally, some evidence that in high tech, healthcare, and manufacturing subsectors with growing intangibles also experience growing rents. Okay, so let me wrap up. I've summarized the key takeaways in this slide. The main message is that the growth in the investment gap reflects a mix of rising rents and rising intangible intensity. Now, taking a step back, why do we think these findings are interesting? Well, they feed into a broader debate about whether market power and rents, pure profits, are rising in the US. And that debate has some very concrete policy implications. To us, it's important to understand the extent to which investment, the behavior of investment and returns is informative for that debate, or whether instead that behavior of investment and returns reflects ongoing changes in the way that firms organize production, the types of assets they use, and in innovative activity more generally. Now, from this perspective, what we find is that rents have indeed increased, but maybe not as dramatically as others have argued. And also the missing investment is not just due to higher rents, but also largely to this shift towards intangible capital. And at any rate, we also think it's important to highlight that broad policy recommendations should be made cautiously because different sectors have experienced very different evolutions with respect to these forces over the last 3 decades. Okay, I think I'm just about out of time, so I had a few additional slides, especially on follow-on work, but maybe we can leave those for the Q&A.
Great, thank you, Nico. That was really great. Had a few questions, so we can follow up. One of the questions, sort of broadly speaking, was about measurement error, or not measurement error, measurement of intangibles. So in general, thinking about the challenges of measuring intangibles, and in particular, somebody asked, when you say intangibles, is there, I guess to some extent, what do you mean? How much of that would be things like R&D versus human capital? Somebody wanted specifically to understand the connection to human capital, but maybe if you could talk just a little bit about sort of the challenges and what it is and how we should think about intangibles.
Yeah, I'm happy to take that unless Jan wants to jump in. So just at a broad level, when people talk about intangibles, usually it covers 3 types of assets. So intellectual property assets, software and data assets, and then a number of other corporate assets like customer relationships, brands, managerial methods, production processes, and so on. So the first one is really IP, the second is software and data, the third is what I've called in this, and what the literature calls organization capital. So how we measure these things, well, that's super hard. There's 2 different approaches at a high level. One is to just look at flow spending on these things. So basically what you do there is you use either firm level accounting data or survey data. Sometimes my colleague at Kellogg, Filippo Mezzanotti, has great papers on this, to just look at how much firms spend on these different kinds of assets, and then you use essentially perpetual inventory methods, so capitalization methods, to come up with an estimate of the stock. So that's one bucket of approaches. The advantage of that is you can, in principle, apply it broadly so long as you have the data on firm spending on these things. The second approach is to use data generated at the moment when a firm sells, either piecewise or as part of an M&A transaction, some part of its portfolio of intangible assets. So when firms do this, they typically, for accounting and tax purposes, have to attribute a concrete market value to different identifiable intangibles in their portfolio. And so at that point, you can sort of capture a market value for the stock of intangibles of that firm. Now, so there's a lot of papers that have done this. For instance, Michael Ewens has great work on this. The issue with this is generally selection. So we don't have systematic data. Not all firms go through these kinds of corporate transactions or sales of assets, and so we can't really compute this for all firms. Though I should say there's also great work by Anmol Bandari and Ellen McGrattan trying to expand this using tax data on transactions among private businesses. But there you sort of run into a bit of a selection problem. So these are the 2 kind of strategies: transaction data and investment or spending data. Now, the problem of human capital, that's super hard. So, to illustrate this, a lot of the R&D spending we see reported by firms is actually wages of R&D workers. So the approach that is taken in this literature that we work in is that the spending creates value for the firm. So, when the firm is spending money on the wages of an R&D worker, it's creating an asset over which it has control rights, cash flow rights, from which it can derive economic benefits. But we're not necessarily measuring or trying to measure the creation of human capital for the workers and the extent to which that human capital might be used by workers, in other firms or to create new firms or something like that. So we're really trying to think about, if you want, the part of the creation of human capital that the surplus from which the firm can retain control and credit and cash flow rights over. We think it's super interesting to think about, spillovers across firms from this kind of spending. In fact, we have some work on this that we might talk later on about. But this is not something we're directly addressing in this paper.
Jonathan, maybe I could add to that a little bit on new data sources that aren't reflected in our paper, but people might find useful if they're interested in working in this area. At the national and sectoral accounts level, actually the EU is ahead of the US in developing and providing this data. There's a version now of the CLEMS data, which has sectoral data and is all internally consistent, that includes intangibles data. And that's pretty good for the EU, the UK, Japan. The US is still developing the sectoral data for that. And they follow the same categorization of the taxonomy that Nico mentioned in terms of the categories of intangibles, the digitized information, innovative properties like intellectual property, and then the economic competencies, they call it, which includes market research, branding, organizational capital type topics. Now, fortunately, the International Accounting Standards Board has also started developing a research project to improve accounting standards on reporting intangibles, which would help improve the precision of all of the things that Nico was mentioning. So I suspect those wheels move slowly, but at least they're paying attention to it. And then as in all of finance, there's more administrative data available. I was just looking at a paper that has data on trade secrets, which is an important alternative to patents for intellectual property, and which they obtained from legal cases. And so they had measures of the impact on trade secrets and the impacts on valuation. So people are getting creative as they tend to do when there's an interesting question about finding alternative data sources.
So if you were, so you on this slide, you mentioned intangibles explain somewhere between a third and 2/3 of the effects of the investment gap.
Mm-hmm.
Would you, given all the measurement issues, challenges associated with that, should we think of like 2/3 as a lower bound? Or is that too strong a statement?
I can jump in here. At the aggregate level, I would venture that it's probably not a lower bound. It's probably somewhere closer to an upper bound. But again, remember that there is the sectors that are mentioned in this slide, where even if you take a very narrow view of it's somewhat narrow view of what intangible investment is. So if you just focus on R&D spending, you still get these very high numbers for where the investment gap's coming from. So again, I think we're back to this idea that in aggregate, maybe 2/3 is an upper bound, but the aggregate is somewhat misleading. There's these very stark differences across sectors. Now, the reason why I'm saying it's potentially an upper bound is that the 2/3 number comes from including our organization capital into the measurement, and that itself comes from capitalizing SG&A spending or a fraction of SG&A spending. And I think there's still, it's actually a topic of ongoing research as to how to do that properly, how to do it in different ways across sectors and so on. So I think 2/3 might be an aggregate a higher upper bound, but not necessarily one we should pay attention to given the amount of heterogeneity across sectors.
And one of the things the Accounting Standards Board is looking at is providing more of a breakdown of SG&A, right? Which would really be very helpful in forming these aggregates.
Right. We had a couple of questions that touched on issues related to basically what does it mean for government policy for regulation. Somebody had asked something about industrial policy, I think, or what I would describe as industrial policy. Somebody else had asked in relation to our previous discussion about human capital is whether this connects or whether this would say anything important about non-compete clauses or the role of non-compete perhaps in giving rise to some of the intangibles or the rents associated with the intangibles. So I don't know if you're willing to talk about policy issues, regulation at all, but any thoughts on those issues?
And I can start off quickly with, I mean, this relates to the motivation for the paper because most previous work has looked either at intangibles or at market power. And you tend to find large effects of each of them in isolation. And they do have different implications. So if you think market power is very important, then you need to dive deeply into competition policy. And if intangibles are an important driver, then that has more to do with innovation. And in particular, and this is related to the non-competes question about how firms turn an intangible, say a new idea, a new innovation, a new practice in the firm into an asset. So does it get built into the value of the firm, or is it just a non-rival idea that's available to the whole industry? And so non-competes, I think, connect with sort of go across both, right? Because they tell you, is the firm able to capture the value of its innovation? And then how do they change the value of the firm? So non-competes are part of this notion of capturing the innovation at an individual firm. So it's kind of at this intersection that we emphasize between rents and intangibles.
Yeah, to add to that briefly, just the spirit of this paper is to sort of take these two mechanisms, rents and omitted investment, as sort of separate from one another. But there is a broader economic question that that we've been trying to entangle with, which is to what extent does intangible investment generate or exacerbate rents? And one view of the world you can take, and this is one that many people saying growth theory have taken, is that the rents we're observing are sort of ex-post rents, but to an extent they might represent compensation for the creation of an intangible asset. And you want to maintain them because without them, the creation of that asset is not possible. On the other hand, as Jan was saying, you don't want to maintain them too much because to the extent that these are ideas that can be used by multiple firms, then there's spillovers and externalities to be had. And so non-competes are kind of a cool example of this. They help the firm preserve some of the rents associated with investing in R&D, so that's good. It's going to encourage R&D, but in the case of non-competes for high-skill R&D workers. But at the same time, you do want to think about allowing these ideas to flow across firms, and that suggests limiting the rents as well. So I think in our approach, we don't have a definitive answer to these questions, but in follow-on work, we're very much thinking about all of this because we think that's kind of the crucial aspect of this debate, the connection from or between intangibles and rents.
So in some sense, one of the first graphs you put up it would suggest that both intangibles and rents have sort of risen together over the last few decades. It's probably, it's too much to suggest that there's an inherent relationship between them. There may be a connection, but that may be as much coincidence or I don't know how you'd want to call it.
Well, we want to be very, cautious about this paper doesn't show anything else than the coincidence, right? Because the way we approach the data is from the lens of a model where these two mechanisms are in some sense separate from one another. That's how we designed the model. So there's there's nothing in the estimation procedure that would mechanically generate the sort of correlation you're seeing on the graph on the left panel here. But we do see it in the data, and so I think that is suggestive of some connection. I don't know, we don't want to say that there's a causality either way, and I think for that we need more data and more thoughtful models. This is what we're working on, but it certainly shows up in the data without us sort of building it in.
Yeah. And in the follow-on work, we're making the observation that intangibles have characteristics, in addition to being hard to measure, that related to being hard to measure, that might make them amenable to generating rents, in that they're easy to replicate. Once you have the first copy of the software, then subsequent copies, or even if they're used within a firm, they can be used across different locations in different lines of business, and so they're amenable to large scale, and which we often associate with generating rents. They may also, because they're easy for others to replicate, firms may have an incentive to sort of make them trade secrets or to patent them if you have good patent protections, which those institutions are intended to exclude use by others, which is one of the characteristics of monopolies or market power. So I think there are conceptual reasons to link the two, in addition to the empirical findings that are on the screen.
So for a while, there was a sense, I think, that patenting had become too easy. Is that, I haven't followed that literature. Is that still, I mean, that obviously connects to what you were just saying, but is there still some thought of that may be true, or?
Yeah, I think there's good empirical evidence, basically two phenomena. One, that firms use patents somewhat strategically, so patent things that don't really necessarily represent innovation, or patent trolls. So firms that patent in order to block innovation by other firms. And then there's another strand of evidence that questions whether, or that asks whether firms are sort of splitting an innovation into many more patents than they used to, so that measuring the number of patents per se is not necessarily a meaningful proxy for innovation. So I think that debate is very much still ongoing in the academic literature.
Mm-hmm. And I think it's furthered by some weakness in institutions that, patents are required to be disclosed. So once you patent, the information is available. And if the protections are not well enforced, that's actually a disadvantage for many firms compared to a trade secret. So we may see some, depending on the strength of and the buy-in to patent institutions, one could see a shift, especially in international patents.
Great. Well, I think we are out of time. There are a few more questions there. If you wanted to answer them, I guess, privately, you can do that. But other than that, I will, I guess, end there since we're at noon. And just again, congratulate you on winning the award, and thank you for doing the webinar. That was great.
Thank you. And we'd like to thank Hackabo and DFA for their support and for supporting the profession and the JF and the prize.
Yes.
You're welcome.
Thank you very much. Thanks a ton.